Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good As Gold. So over the past week, gold has actually been stuck in a holding pattern, hovering around the $2,300 mark. The fast leaning towards rate cuts and, some shaky geopolitical developments and China's strong appetite for physical gold from both retailers and the PBOC have all been giving gold a nice little cushion, but without any fresh catalyst, it's been tough for it to break out as well. Traders are now all eyes on next Wednesday's US CPI data because that could drive the gold price to start moving again. So taking a quick peek at the recent gold against US dollar daily chart, it's been pretty plain, I would say, bouncing between $22.80 and $23.30 since last Wednesday. Even though it took a tumble for 2 weeks straight, it's managed to cling to around $2,300 on the upswing, hitting the local high of $23.52 on April 26 as a big challenge before aiming for $2,400. And on the flip side, $2,300 and the recent low of $22.80 are holding steady, keeping gold from sliding down. So after my shortest technicals talk ever, let's dive into what's keeping gold from getting its groove on. In the US, last Friday's April non-farm payroll report was underwhelming. Jobs added only ticked up by 175,000, falling short of the 243,000 forecast. Unemployment nudged up from 3.8% to 3.9%, and wage growth cooled off a bit. Plus, both the April ISM manufacturing and services indices dipped into the contraction zone, making the market think the Fed will just have 2 25 basis point rate cuts this year, with the first cut possibly happening in September instead of November. That caused the US dollar to briefly lose the 105 mark, and the 2-year US Treasury yield slipped from 5% last week to around 4.83% today. Also, starting next month, Uncle Sam will reduce the balance sheet runoff pace from $60 billion to $25 billion, signaling the fast easing is on the horizon. That's making it cheaper to holding on to gold, giving its price a nice boost. However, the progress in getting US inflation back to the 2% target has been somehow largely stagnant in the first quarter, with the US ECI inching up by 1.2% over the same period, showing that labor costs are rising. And even though both April PMI data came in below 50, the prices paid sub-indices were surprisingly strong. Although market pricing for rate cuts has become more dovish, the Fed may proceed with caution, and gold prices will continue to be pressured by the Fed's reluctance to cut rates in the short term. Meanwhile, in the Middle East, things are as unpredictable as ever. Last weekend, we were hearing something about, major progress in the Gaza ceasefire agreement, but now it looks like Israel's making moves again. In this case, gold, being the go-to safe haven asset, is finding it hard to pick a direction. And lastly, let's not forget about the big support of gold prices, China's huge appetite for physical gold and central bank purchases. In last week's video, I actually talked about data showing the love for gold from China in the first quarter, and here's the kicker. Even though gold shot up over 20% since mid of February, Shanghai gold prices have been hanging around 5% higher than London gold prices, showing that China's not sweating the price hikes too much. With a hefty and a steady demand like that, gold's got a solid floor around $2,300. So in a nutshell, gold's been hovering around $2,300 in the past week. The mixed signals about the Fed rate cuts and geopolitical developments kept it from making any big moves, while China's significant and stable gold demand remains an important force supporting gold prices. This week, we are expecting 11 Fed officials to talk, and I reckon they will just keep saying something like the inflation is still high and rates need to remain high accordingly. So gold might just keep snoozing until next Wednesday's April US CPI data drops. That could be a real game changer. Everyone's expecting the core CPI month-on-month growth to cool off from 0.4% to 0.3%, and the year-on-year growth to drop from 3.8% to 3.6%. But if there's another upside surprise this time, the market may price in the Fed cutting rates only once this year, or even, delaying it until next year. It would boost the US dollar and put pressure on gold. So this is pretty much for this week. If you have any thoughts on where gold might head next and some potential catalysts, please feel free to leave them in the comment box and let's discuss. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!